Welcome back. Still with me in the studio, Jason Sharpe, Chief Executive of Paramount Life, and Stephen Nathan, the Chief Executive of 10X Investments. We're talking about something that I think, maybe you guys will agree with me. We tend to adopt the ostrich principle here and stick our heads in the sand. Is it true of us South Africans? Yeah.
The world over.
Oh, really?
I think we do. I think the one thing in South Africa that we are very lucky is historically our government has had quite good legislation to try and encourage people to save.
It's not working at the moment.
It's not working. However,
you can have as much legislation as you want to. It doesn't necessarily mean that...
Although positive legislation like tax incentives to encourage people to save do help.
But we're still not saving.
You've got to... The only way you're going to get savings is to make it compulsory. People are too short-term. You're right, they can't think about it, it's too complex, we have instant gratification. So unless you compel people to save a certain percentage and you compel them to preserve that until retirement. So we need a culture in South Africa that your retirement savings, all you're going to get out of your retirement savings is an income stream in retirement. It's not a piggy bank, it's not a short-term deposit that you can withdraw on when your circumstances change.
But 2 points come out of this now immediately, and we're getting sidetracked already. The first one is the instant gratification thing. We live in a society right now where instant gratification is the name of the game. You mentioned it earlier. You've got your R1 million there. You look at it when you're retired and you go, you know what, it really won't make much difference if I use that 200,000 for this. It's going to make a huge amount of difference. The other thing is we've got people who are living on social welfare who are not earning money and expect that to continue and continue and continue until such time as they go to the grave.
Yeah, well, the perfect example I often use for that is the concept of a provident fund in South Africa. And this is a very controversial subject. Why? Provident funds, as opposed to pension funds, allow people to take all their money at retirement that they save for retirement and go and blow that money or do whatever they want with that money. Unfortunately, in many cases, people don't realize the amount of tax that is payable on pulling money out of a provident fund. And even though they may not have saved enough money, they're giving away that money in tax. Now, we deal with a lot of provident funds, money exiting a provident fund being used to buy an annuity, and I can give you an example of one of the largest provident funds in the country that had not allowed the purchase of one single annuity in the past 5 years until we did one a couple of months back. Why? There's no understanding about the life expectancy, the issue that that money has to last a long time. In addition to that, if you're a person who, say, has 600,000 Rand available in a provident fund, and you know that'll be equivalent to a social welfare grant, you're saying to yourself, why not spend that 600 as quickly as possible and go and get the social welfare grant afterwards, and you've now 600,000 Rand better. I strongly believe a lot of people, particularly in the lower end of the market, have saved significant money, but the way that money is being used post-retirement is the big problem. Why? People don't know what to do with it.
So they're using their capital.
They're using their capital very quickly, and it's one of the reasons why we as a business, as Paramount Life as a business, we encourage the use of financial advisors, because unfortunately the man on the street can't easily comprehend that long-term investment.
Right. Now, this is where I come in. This is my bugbear. Based on everything that everyone has been saying here this evening, you have to take responsibility for your own retirement. Gone are the days where you paid your retirement, whatever the amount was, and you got that paid out and you knew it was going to cover your costs. You have to take personal responsibility. You can go to as many financial managers as you want to. Most of them end up just charging you fees, and at the end of the day, if something goes wrong, there's no liability there.
There's a difference between making an uninformed decision and an informed decision.
But I would rather make informed decisions myself based on information I can glean, and there's a huge amount of information available.
But let me give you a simple example. We talked about the R1 million and the 10,000 Rand a month of income, or the 100,000 Rand a month of income. That means the person in a living annuity context, which is one of the products for long-term, for compulsory money, you would start off drawing 10%. Within a shorter period as 7 years, if you're increasing your income by inflation, you would have reached the maximum 17.5% drawdown in a living annuity. That means that you're going to slowly see a reduction in income for the rest of your life. If you had gone to a financial advisor and the financial advisor had shown you the projections, you making an informed decision and understanding the risks with retirement. A person sitting at home and saying, wow, £1 million, I'm going to draw 100,000 Rand a year, isn't looking beyond that period. He thinks he can potentially earn 12%, 13%. I often joke with a lot of retirees that we interact with, there are 3 things in life that are certain. Death, taxes, and your neighbor lying about how much money he lost on the stock exchange. That's just the reality. People think they're going to earn more, and they take on that risk with an uninformed decision. With a financial advisor, at least what you know is the facts are put in front of you. You talk about rules again. If the advisor doesn't disclose everything to you, the consumer has the Financial Advisors and Intermediary Services Act on their defense, that where they can claim if an advisor has misinformed them.
No, you're shaking your head. You're shaking your head.
You know, let's be realistic. A lot of the bad products that are out there have been sold by financial advisors, the vast majority. So the reason we're in so much trouble is not because we have wonderful financial advisors making wonderful informed decisions, doing things efficiently with great products. So the whole industry is just entirely complex, and in my experience, it's heavily weighted against the investor. Because who do you trust and all the products, and can you even understand it? And
no,
I don't. The financial projections are woefully inadequate. They would not fail any test. So all these financial projections, when you get to retirement and someone projects your living annuity, I've sat down with the financial advisors and I've looked at how they do their models. And all they do is they say, well, returns are going to be real return 5%. So they assume a return, which is fine, but they don't do 2 fundamental things. The first is they don't include costs. So if you look at any living annuity, including the CISA, they say 5% is more or less a drawdown rate.
What is the CISA?
The CISA is the Association of Savings. It's the life assurance industry and the collective investment scheme industry. So it's kind of an industry body, and they say 5% is a rough rule of thumb.
Okay.
So it's so you're drawing 5% of your capital, and you should be able to maintain that and grow that with inflation. However, what they don't do is they don't say what are the costs. The average cost of a living annuity is 3%. So it's not a 5% drawdown, it's an 8% drawdown. It's gross 8, 3 goes to fee, 5 goes to you. So these financial models don't take account of it, and they don't take account of volatility of returns. So all the financial advice I've seen in terms of living annuities would fail, and I certainly don't have the confidence in phase that these people are going to get ferreted out, because these are amongst the top people in the industry.
I would maybe dispute that. I'm very worried when people paint all financial advisors with a broad brush. Agreed, there are some financial advisors who don't do the projections correctly, but there are many that do the projections correctly, and the projections need to show variation. That's the crucial thing.
I haven't seen it. I've sat with the top guys.
But maybe sometimes the top guys aren't the people for everybody. You've got to look at the middle, and we always look at the middle. I can tell you, good news is we are launching a living annuity that will have significantly lower costs, but at the same time will allow advisors to earn commission to be able to give that advice. I'm strongly in favour of advice. I will say that.
Yeah, okay, fine. I'm not disputing the advice thing, but what I think I'm picking up here is the cost aspect of it. The cost of that advice. I don't mind paying somebody to give me advice. But when I hear, which rocked me back a bit there, that I'm getting 5% of it, and 3% of it, this is my money, is going to the people who sold me the advice and the annuity. They're earning almost as much as me, and I work for it.
But there's a big difference over there in where the costs are going. The 3% Stephen's alluding to is a mixture of multiple costs. Typically, on a living annuity, the advisor is receiving maybe 0.5% to 75.75%. The rest is going to asset management fees. Now, if we talk about asset management fees, I think that's a bigger discussion. Everybody's attacking the advisor, but the ability for the advisor to give products with low asset management fees is a bigger issue. I think that is the big issue, because if you start talking about 3% and you take off 75 basis points, you're talking about fees of almost 2% going to asset managers. There comes a big question mark.
Okay, maybe that's something we need to look at in another program. Let's try and get to a point here. What position should you be in when you retire, Stephen, in your opinion? I would immediately say I wouldn't want to have any debt whatsoever. My kids should be looking after themselves. I don't want to look after them. And I need that R1 million in the bank that you're talking about. What are the other pointers here?
No, you're right. You've got to be responsible about it. So the first thing is to say, how much money do I need? 10 times your final salary is a good minimum. There's more sophisticated ways you can take your expenses and work out exactly what you think your expenses are going to be. If you take your expenses and you multiply them by 20, that's a good number as well.
Okay.
So, but that's going to give you a rough indication. It doesn't have to be exact. It's going to be good.
I just want a rough indication.
It's going to be good. So the first thing is, am I going to get there? So you've got to be a disciplined saver and you've got to be a disciplined spender. So you're exactly right. We must live. There was actually one of the financial magazines had this last week, living within our means. I think as South Africans we're not living, and we need to. So just do that. When you get to retirement, if you haven't got your 10 or your 20, your 10 times your final salary or 20 times your expenses, then you're going to have to make very difficult decisions. So the best thing is get there with enough money, and you'll be making easier decisions in retirement.
30 seconds.
Retirement is not a single point in time. Retirement is a process. You need to start at least 5 to 10 years before your retirement, starting to get quotes about what the cost of retirement will be, and start adjusting your budget in order to maximize that. You can transfer the risk. People don't need to be scared of transferring the risk and getting value for their money.
There's a lot of information that we haven't shared. Unfortunately, we are out of time. What I'm going to do, there are the website addresses that you can go to get more information from these two particular companies and these gentlemen, and you can start digging around there, and hopefully you can find a few more facts which will make it a lot more easier for you. That's it for this show. We'll catch you next time. Bye-bye.